Hello friends. Welcome back to your channel. If you are looking for the right content on investor education, click on the subscribe button and click on the all notification bell to get these content right on your phone. Today in this video we are going to learn a very important aspect of analysis which is simple and easy, which if understood, will give you the edge to avoid companies fudging their numbers and manipulating the stock market. This in turn will help build our portfolio with quality stocks which can create wealth in the long run. You see, there are two important statements which tell you the health of any entity. Profit and loss and cash flow statement. Profit and loss statement contains parameters such as net sales, other income, total expenses, operating profit, interest, depreciation, exceptional items, profit before tax, net profit and adjusted earnings per share. Whereas the cash flow statement explains the reasons for change in cash. It contains information about non-cash investing and financing activities. It is also a legal requirement and helps to evaluate the financial condition of any business entity and thought process of the management strategy. The formula for earnings per share is net income minus dividends divided by total number of outstanding shares. For instance, ABC Limited records a profit of 5 million rupees and needs to pay 500,000 rupees dividends to the shareholders. The company has a total of 1 million outstanding shares. The earnings per share will be calculated by deducting 500,000 from 5 million divided by 1 million gives an earnings of 4 rupees and 50 paise per share. It means the company generates 4 rupees and 50 paise for each of its outstanding shares. The adjusted earnings per share is the addition or reduction of non-recurring components in the net income. For instance, a one-time gain from the sale of equipment or a subsidiary included in the earnings can result in higher adjusted earnings per share than basic earnings per share for a given period. So therefore, the P&L statement tells you how much is the profit, how much was sold and what was the profit/loss percent. However, there may be flaws in the way the accounting in the statements are done. Sometimes the profit and sales shown does not account for the actual money coming into the books of the entity. This accounting flaw can be found out from the cash flow statement. For instance, let's say A sold their product to B at 100 rupees. Then there will be some expenses from the manufacturing till sales of the product, let's say 20 rupees. So the profit will be 100 minus 20 equals 80. However, in your P&L statement you already might have shown it as sold and profit accounted for. However, not all the money comes into the books immediately. There may be delays or some may not even come. So the cash flow statement represents what money is received from the sale of goods or services. So in a sense the cash flow statement helps you to find the actual financial position of an entity and also helps finding flaws in accounting of entities just showing numbers. In this statement shown on the slide, you have to look at operating cash flows for a 5-year period since these numbers may not be giving you an accurate picture if taken in silos. To find out whether there is incorrectness in the way financial numbers are depicted, all you have to do is compare the cumulative numbers of last 5 years with that of the net profit of the last 5 years. If the net profit amount is closer to the sum of operating cash flow, then the company is doing good in terms of business revenue. However, if there is a huge gap in the revenue and cash flow, then it must raise alarm bells for you and tread with caution. However, this is just one way to avoid investing in businesses where there is misinterpretation of financial numbers. But this alone cannot be used to find out quality businesses. So you would need to evaluate various other fundamental parameters to judge an entity. Hope through this video, you were able to learn how to analyze the profit and loss and cash flow statements and thus find out if there are any anomalies in the reporting of numbers. Thanks for watching. Until then.